In the last few months, I came across a phrase which I was completely unfamiliar with, a reverse mortgage vacation. And so I did my investigations, and to help us explain more as to what is a reverse mortgage vacation, we have with us Harlan Okola. He is the National Reverse Mortgage Director for Movement Mortgage. Harlan, good to see you again, my friend. So what in the world is a reverse mortgage vacation?
Well, Shannon, the reverse mortgage vacation, a lot of people have asked me, what the heck is this thing? And it's one of the most fun parts of my wife's and I fourth quarter of life. It's pretty cool. And unlike a lot of people that use a reverse mortgage to get income, I purposely did not pay off my mortgage before I was 62 because I knew in my 40s I was going to do a reverse mortgage when I turned 62. So a couple of years ago, when I did my reverse mortgage, I eliminated a mortgage payment on a new house that we had bought closer to the kids and the grandkids. And of course, anybody that has grandkids knows that it's an incredibly wonderful thing. And so I wanted to spend more time with them, and also wanted to spend more time just kind of reconnecting with our sons and their daughter-in-law. So we have four sons. So I announced when we did our reverse mortgage that, hey, family, we are going to have a new tradition. We're going to call it reverse mortgage vacations. My mortgage payment was about 3 grand a month, which is about $36,000 a year. That should take care of a few vacations because it just went to zero. And so we have only two rules. The first rule is you have to plan the vacation because I hate planning all that stuff and getting all the reservations and all that sort of thing. Secondly, you must take mom and I along. We're not paying for your vacation without us because this is a bonding thing. And we'll take your kids, we'll take, you and your wife. No restrictions on where we're going, what we're doing, or anything else, because we've got kind of a decent sized budget. I'm still working. I can afford to make a mortgage payment, but we're not. And so we want to put it into vacations. Since that time, Shannon, we have went to a tour of Europe, Iceland, which was really cool and highly unusual. Of course, a couple places in Mexico, Kauai, and some places here in the United States. We have created memories that I've got all over my wall here and in my head that are way more valuable than any kind of inheritance that I could give them. And we have, when I'm at my deathbed, we're not going to be thinking about how much equity we have in our house, but we are going to be thinking about how wonderful those trips were. And remember when we were in Italy, and we remember when we, spent that time in the helicopter in Kauai. I would recommend it to anybody. I'm just a farm kid from Wisconsin who understood our reverse mortgages worked. And here, because of that, our family has all these incredibly great, fun times because our goal is not to die with the most equity, but to have the most memories and the most fun while while we are heading down the road of retirement. So I recommend reverse mortgages to anyone because it is the most wonderful thing, and having fun with your kids and with your grandkids. Do you realize how close you get to them when you're together with them, staying in the same Airbnb, on the same airplanes, same trains, everything else for a solid week, 2 weeks, whatever? You really get to know someone, and it's not just a couple of hours when you're over to their house for dinner. It is a very wonderful time of bonding and learning about your adult children and your new grandkids. It's something that is hard to describe until you do it yourself.
That was absolutely perfect. I love it. Love it. All
That
right.
might have been too long. That might
It's
have
a
been too
great
long.
segment. No, I'm going to do so. It's going to be in the audio and the video edition of the podcast. Love it, Harlan. It's so true. One of my favorite phrases is memento mori, which is remember you must die. The old Roman saying, from the Stoics. And it's true, man. Every day, you got to take advantage of your time with your family.
Well, it is so true. And when we were walking around on the glacier in Iceland with my one son and his wife, and when we were up in that helicopter, and in Kauai, when we were playing golf in Cabo, it was like, at one point, and I should have had this in recording, but we were having a drink on the beach, and my son said, "Dad, this is really cool. This is special. I can't believe, what a neat thing this is." And I said, "Well, actually, Isaac, you're paying for it." And he said, I thought you were." And I said, "Well, we are, but this is decreasing your inheritance, because if we took the 15 grand that we paid for this trip,
Right.
and we invested that, you're a analyst for your company. Add that up. What's that worth in 20, 30 years?"
Yeah.
And he lifted his glass and he said, "Hey, Dad, I'm good with that." uh, it was just one of those moments that I kind of wish I had filmed, because it was, yeah, I really don't care about the inheritance. This is cool that we're hanging out together here on a trip, and having fun talking about things. You learn things about your kids that you otherwise wouldn't, because most of your interactions with adult kids
Right.
are maybe a few hours or a couple of days, if they come over for Christmas or whatever.
Yeah.
But you don't spend that much time talking to them, and it's usually in a group.
Right.
And
Exactly.
so you really, and so when you are one on one, like with our one son, he helped, he did the best planning of anyone. It was my dad was in World War II, and we found after he died, after mom and him both died, he was last, a whole bunch of love letters that he had wrote to my mom when he was in World War II. I mean, stacks of them, uh, a couple hundred. So my kids went through and um, put them. My dad had horrible writing, so took all of the letters and, on this side, put the letter and then typed it all out.
Translator.
On Yes, translated it so you could actually read, and it was really cool stuff. So this was from Alsace, France.
Oh my
And
God.
so he mapped out where Dad was from Italy to Switzerland to Austria to Germany, and then where he ended up in France before he came home. And then we retraced his steps during that 2 weeks. And then he would say, "Okay, today we're going to these mountains in Austria where we, your dad was, back between this time period," or whatever. So he had, I mean, I just felt bad. I felt bad that I didn't take my dad back there. Um, but it was an incredible experience, and and just talking about, what it was like. Dad was over here in Europe, and
Yeah.
there was no FaceTime. All he just communicating with these letters for 3 years or 3.5 years, whatever it was.
Yeah.
And it was just, it was fascinating.
That
Uh,
is. What?
it, you learn a lot from
Yeah.
your kids, and that was certainly a awesome opportunity.
A variable interest rate on any loan could be risky, especially when interest rates are increasing, which we have seen for the last 2.5 years. However, we're beginning to see signs that interest rates may be cooling, and those particular loans may become less prohibitive, and for many borrowers, they may be actually an advantage. Home equity lines of credit, or HELOCs, are just one such product. In 2022 and 2023, taking out a HELOC could be dangerous for homeowners, as interest rates were increasing on those line of credit payments, and they were likely to continue increasing as the Federal Reserve embarked on their war against inflation by raising interest rates. Now, however, with one interest rate cut already of 50 basis points in September and additional rate cuts expected in future Fed meetings in November and December, HELOCs, or home equity lines of credit, could once again be a powerful borrowing tool for today's homeowner. Today, the average home equity held by homeowners is now close to $330,000, and that gives them a lot to work with. So this column explores, what if a homeowner got a $60,000 HELOC, and what would those payments be, and how could they leverage that HELOC to their advantage? Of course, we know that gives them access to cash for anything from home improvements to emergencies. But first, due diligence should be done, and how much they're going to be paying each month. So how much does a $60,000 HELOC cost now that rates have been cut? The average HELOC interest rate today is 8.74% as of October 10th, but as rates frequently change, we can expect them to adjust each month, and that will, of course, adjust the payment. So here's what a $60,000 balance on a HELOC would cost based on two common repayment periods in a HELOC, 10 and 15 years, based on a static 8.74% rate. With a 10-year repayment period, the payment would be about $750. With a 15-year payment period, it'd be about $600. Now, they do mention reverse mortgages, which allows them to tap into their equity without the burden of payments, but ultimately, of course, the loan has to be repaid when the homeowner dies or the home is sold. But borrowers don't have to worry about an evolving rate climate or adjustable rate with a HECM, as there's no required payments. But that said, reverse mortgages are reserved generally for those 62 and older for the HECM, and younger, as young as 55, in fact, for proprietary loans. But they recommend that you do your research and also speak to your current trusted lender as well as others to determine if that makes sense for your current financial situation. A $60,000 HELOC comes with inexpensive monthly payments now, but they could actually go up if interest rates increase and even fall if rates are continued to be cut. It's important to remember, however, that rates on those loans do fluctuate and they can rise just as easily as they fall. So don't take on too much risk when getting a HELOC, and remember those payments throughout those 10 or 15 years. In September, the Federal Reserve, our central bank, reduced the benchmark interest rate by 0.5 percentage point, and that brought the Fed funds rate to a range of 4.75% to 5%. Now, that is the rate which banks borrow overnight from each other, but it is also a very influential interest rate on the economy as a whole. MoneyWise says for seniors, there are several reasons that these rate drops could be a good thing, but there are also some downsides. Retirees must understand the full impact of rate cuts to make smart financial moves in the future. And that is especially true as multiple additional cuts by the Federal Reserve are expected, and that could bring the benchmark rate down as low as 2.875% by the end of 2026 per JP Morgan. So here's the good news and the bad news for seniors, along with some tips on how to thrive as rates decline, according to MoneyWise. The Employee Benefit Research Institute recently said that 66% of American families with heads of household 55 and older have some debt. It added, furthermore, the percentage of families with heads of age 75 or older having debt, and specifically credit card debt, are at their highest level since 1992. When the benchmark rate falls, banks often pass that savings on to the consumer in the form of lower rates on loans and credit cards. They add that borrowers with an existing variable rate loan, including credit cards, home equity lines of credit, which we just discussed, and reverse mortgages, should see their rates and monthly payments go down. Of course, with a reverse, there's no payments. It just means that the accrual of interest would slow as rates are cut. Also, the rate cutting cycle contributes to falling mortgage rates, which we don't want to overlook because that increases demand in the housing market. Now, that could also drive up prices, which would benefit older homeowners, but also it could further constrain the supply for first-time home buyers and keep prices elevated out of the reach of many. So that shot of adrenaline to the housing market could help the older homeowner grow their wealth considerably over time, as it has already. Unfortunately, it's not all sunshine and roses for seniors. There is one big downside to rate cuts, and that is many retirees have a lot of money in safe and very conservative investments, such as bonds, CDs, and high-interest savings accounts or money market funds. Now, unfortunately, those type of investments are also going to see their yields fall with interest rate cuts, perhaps dramatically as the Fed begins slashing rates in the future. Thank you for joining us for this week's episode of HECMWorld Weekly. Don't forget that you can subscribe to this podcast on our YouTube channel and also hit the notification bell. That way you never miss any upcoming episodes. We do have an audio companion to this podcast, which you can find on Apple Music, Spotify, and on Podbean. Thank you so much for joining us, and be sure to return next week for more reverse mortgage related news stories for you, the mortgage professional.